Hello everyone. Before coming to the main conversation, let's warming up a bit. Let me introduce myself first. My name is Harry. Currently, I'm working as analyst or data analyst at Spartan Group. We are one of the venture capital in Singapore and Hong Kong, mainly from the advisory side. So, yeah, coming to all the main character here, can you guys, each people, give all of the audience one of the introduce, let's say, in 2 or 3 sentences, so everyone can know about your, what you guys do.
Okay, cool. Hi. Hi everyone, I'm Thiệu. I'm actually, we are actually not a VC as the definition here on here. We are more or less a quant fund. We trade a lot in the liquid side of things. So I guess my voice is coming today is gonna be more from that perspective. So Vimian Capital is a quantitative hedge fund. We trade on a lot of centralized exchanges, but moving a lot of our volume on decentralized exchanges. We are just relocating most of the team back to Vietnam and looking forward to be based out of Vietnam in the near future.
Hi everyone, my name is Min. I am the COO at Animoca Brands. We are a blockchain and venture capital investor. We invest across private and liquid deals. We also incubate our own projects. It's always embarrassing to come to Vietnam because obviously I have a Vietnamese name, but unfortunately I do not speak any Vietnamese whatsoever. My dad is Vietnamese, he lives in Saigon, but my mom is from Hong Kong, so I grew up there. So apologies, but I do not speak Vietnamese, but very happy to meet everyone. So looking forward to the discussion.
Hi everyone, and thank you so much for GM Vietnam for having me here. I'm Alex, I'm the VP of Research at Republic. We are an end-to-end digital asset platform where everything from the design and structuring of these assets, their tokenization, their distribution through multiple licensed entities throughout the world, as well as post-listing support is all offered in one place from us in terms of the investment side and sort of VC adjacent side. I've designed just about 100 tokens, 12 of which have reached billion-dollar valuations. And we operate not only venture funds, but also a hedge fund that trades both in private and public markets.
Hi everyone, this is Belinda Zhou. I am the founding partner of Sharding Capital. Sharding Capital is a crypto fund based out of Dubai. We invest both in the primary market and secondary market, and then we also provide our portfolio project a lot with go-to-market strategy support. Very glad to be here today in Vietnam, and looking forward to share what we are seeing in the market on the investment side later on. Yeah.
Thank you. So then let's kick it off. I think back in the day, for today is 2025. You guys have seen a lot of things going on in crypto since 2017 and 2022. So there must be a lot of change. From trend we have from DeFi, from NFT, from meme coin, and then from AI. So what do you think currently today in 2025? What is the most interesting trend in the market in terms of VC perspective, both from primary market and from secondary market, from liquid funds also? What is your view on that? Maybe we can start with Tao from Birmingham.
I think in 2024 we saw a lot of appetite in trading on chain, and especially with the new meme launchpad wars with a lot of people, especially the younger generation and the Gen Alpha stepping in to create their own coins and everything, and then that attracted quite a few wave. I think with the recent pump fund launch and the change in appetite and narrative, we have come to, at least in the liquid market, has been more focused back on the OG DeFi protocol. And then a lot of them found product market fit, like Ethena, like Maple, and like all of this. And then they've been here a long time, and then they suddenly found the renewed interest. Although fundamentally, I would say that they're just doing what they set out to do and then innovate on top of it. I think the interesting thing that came out of that is that eventually you will look past all the hype and the short-term thing and then focus on what the real products are and giving those products the credit that they deserve. That's a hopeful thing for us. I think for the private side, at least for Vimian and then our circle, we have been participating in more of like the RWA stuff, tokenization of real world asset, and with legal framework, starting from the US and then trickling down, and even in Vietnam, we're discussing recognizing digital asset and digital currency. We want to, also because we came from TradFi, so we do have like a bias towards that, and that is where we are going to put a lot of not only capital, but also our expertise and also our support in trading on the platform early, in helping structure the product, and also helping them get to the market that they want to reach. So that's the two things from our side.
Yeah, so maybe I'll start by saying, like, first of all, Animoca is a mission-driven company. So we're actually not structured as a fund. We don't have LPs. We invest out of our balance sheet. And so we are actually very focused on consumer adoption and broad adoption of blockchain. That's really where we're focused. Having said that, I'll echo some of Tao's observations. So I think 2024 was obviously the meme coin cycle, and there was a lot of craziness and not a lot of fundamentals. And I do think the pendulum has swung very much back in favor of fundamentals, projects that have been around and have been building for a long time. I think a lot of that is driven by the regulatory clarity that is very clearly coming. So if for those of you who pay attention to the US market, obviously the Genius Act just passed, but fundamentally, probably the more important act is the Clarity Act, which is in discussions right now and will hopefully come to become law in the US in 2025. That is a fundamentally game-changing piece of legislation in the US, and I think will drive the rest of the world from a kind of both a DeFi and a blockchain infrastructure perspective that will give legitimacy to all of these projects that, you know, the US, which is still the largest capital market by far in the world, was really lacking over the past 4 years. So I think we're definitely seeing that trend, and it's clear that obviously institutions, like the global institutions, are coming in into Web3 and into DeFi as well. I think on the consumer side, we're still in the earlier stages. So Animoca is very active in the identity space. We invest quite heavily there, where we see that consumer identity and data protection is going to be a fundamental driver of Web3. The most well-known project there globally is WorldCoin. But we have our own product that we're building called Mochaverse, and there's also a project that we're heavily invested in called Humanity, the founders here at GM Vietnam as well. So we see that space as a very important next step, because the future of the internet, you know, really right now, if I'm sure that, you know, a good number of you guys use AI already. The future of the internet, there's really kind of just two paths, right? One path is Google and OpenAI, they own all of the internet, because your interaction day to day with the internet is with those platforms, and they just scrape everyone else's data. Or there's a future where we actually own our own data, and then we control which AIs access our data. And so we believe in the latter vision, and so we hope we don't end up with the former, but that's definitely a risk today. I think finally, I'll just touch, obviously we're known as a gaming investor. I think it's clear that, you know, Web3 gaming is not yet hit prime time. We do believe that it will come, but it's going to be a slower cycle than we would originally anticipated. So, you know, we are still bullish in gaming, but we don't see it happening this cycle in terms of gaming hitting prime time.
Two most exciting things. I would start by saying that I'm first and foremost a little bit of like an AI apologist. I think at first I was quite bearish on this vague notion of AI intersecting with crypto. However, I do think that how it intersects meaningfully, not necessarily on the technology side purely, is how it just changes what types of decisions the consumer and even institutions are going to be making. The simple idea that yes, you mentioned data, but I think the idea of permissions and decisions, having AI take all of the dealing with all these, not only the exigencies of life, taking care of making your shopping orders, but in sense executing trades for you, things of this sort. This is going to change the game because it essentially is taking the role of things like sovereign wealth funds and wealth managers, but to an individualized level. I think that being the case in the at least VC and private markets, this is the thing that I do think will potentially cause a big, dangerous but exciting bubble in the all types of financial markets in general. And that sort of leads me to my most exciting thing in the public realm, which is certainly these days in RWAs. And that was a term I also was extremely sort of repulsed by before, because it had this sort of air and stench of people who could not find liquidity for assets that nobody wanted to buy. However, these days with, and I would be remiss to not mention our own impact on this, in bringing the people what they want to buy regardless of the opinions of the issuer. That's something that we're doing very recently, and with tokenized SpaceX, tokenized Anthropic, tokenized OpenAI, and many more to come. Whatever you want to see, we will figure out a way to tokenize it for you. That all being said, I think the RWA approach that we are taking and other firms are taking, looking at what people want to buy first and offering them that first, is a much more exciting time. And with that and how it intersects with the AI world, is basically saying that all the best pre-IPO deals or any RWA you want to invest in but have no access to today, there are people that are working for all of you and all of the people around the world to get access to more and more, and will not stop at anything to make that happen.
Yeah. I would say this cycle, I see the product thriving are product with real users, real revenue, and real product market fit. If you see some of the products that do well, or like tokens do well this cycle, they are, for example, Hyperliquid. It's a platform that people actually use. It's BNB, Binance. I guess like the majority of the people in the room know about like the biggest exchange. So it's a product that people use day in and day out. The product that generate protocol level cash flow that can do well. And I think the days of trading vaporware like air, hopefully it's behind us. And I see quite some like there's kids here, there's also like, more senior people here. So one thing we need to be really careful is like, there's a lot of noise in the market if you're thinking about investing into crypto. So always really make sure like, if it's something you want to invest, you try the product, or you really hear how the users say about the product, and then how big the user groups are. So you get to decide your investment decision. And one thing I can share is that in the primary market, like the VC space, we are gradually slowing down in deployment, especially I think more for smaller funds and then maybe Asian funds. Maybe the US ones are still deploying. So if you get opportunity that you get to invest in the early stages, like seed, pre-seed, maybe be more careful. You could easily lose money. And we are seeing more aggressive like inflows in the secondary because there's more liquidity. Yeah, and like then you need to be also quite selective with I would say your bets. If you're more looking at like say crypto, then you look at, for example, the majors like Bitcoin and Ethereum, which is like what most like say project built on, and then you also have Solana, like with a lot of users, etc. Or probably Sway, they have also a strong presence. You choose like the ones you know more, and then if you look at like having crypto exposure via traditional finance, you can look at, for example, equity plays like say Robinhood or like Coinbase or Circle, etc. These like big companies that have like a very strong presence and have staying power. There are a lot of like say treasury companies these days. I think it can be quite risky because essentially it's leverages, and I see the bubble forming. So I would suggest like unless you really know what you're getting into, always be cautious. But overall, yeah, I think the real meta, the real alpha is, and the trend is like, a product that have like a real revenue, real users. So I think that's the most important thing. And be careful in investing because I think we are in the later stage of a bull run, or at least like, I feel like everything is accelerated in this bull run. Usually for everything to run up this fast, it required longer time, but this time it's just very short. And I feel like we see a lot of rush launches and then very frothy patterns. So I think always be careful with what you invest in crypto, even though it presents great opportunities.
I think all the audience here already gain a lot of insights, valuable insights and lessons, maybe alpha also from all the investors here. So I think I want to explore more one of the details from Belinda. You mentioned VCs nowadays are trying to seek out for more opportunities in the liquid markets. What is your opinion on that? Maybe this is a question for everyone, but I want to ask with Belinda first, because you are one of the funds have the structure from both primary and also liquids. What is your thoughts on that?
It's just the returns are speaking for themselves. We invest I would say about 30, 40 projects past 2-3 years, and the return is not as high as our say investment return in Bitcoin or Ethereum or Solana, etc. I think there's a lot of reasons for project not doing well, as in this primary market project, because sometimes they raise at a high valuation, and then they struggle to have revenue, and they struggle to have users. Then whatever they do, for example, airdrop to say token holders, that's sell pressure. They pay listing fee, that's to exchanges, that's sell pressure, and then they provide all sorts of say community incentives, that's sell pressure. Then this protocol is very hard to perform well on the token side. And then it's just a lot of efforts as private investors, and then to support them, and then your capital also get locked up. But now we see on the say secondary market, there's more opportunity because there are products that have already proven their product market fit. They have proper revenue, they're growing, they have strong TVL, total value locked, they have a wide user base. Then it makes sense probably to invest into tokens of this project. And then because also they are listed on multiple venues, they have good liquidity, so you can exit relatively easily. But if you invest into tokens in the primary market, you need to wait until it's listing. And then after it's listed, you need to look at liquidity. And sometimes the liquidity window is very, very tiny. Maybe on the day of listing, okay, you get to sell your tokens, but sometimes there's a long lockup. And then after you get your unlocked tokens after several months, the token is not doing much. And unless there's a big announcement, etc., then maybe you can sell some of the tokens. But it's almost like you are becoming counterparter for the project if they don't really run well. So it's just a lot of efforts put in for very minimal returns. Then you probably do better by putting the money into Bitcoin, Ethereum, etc. So because of this, then we notice it's not for say people with not say we want short-term returns, but within 1 or 2 years, you probably won't get your investment back. Yeah.
Yeah, I think I completely agree. I want to love to hear more about how, because you also share recently you are also looking into the liquid market. What are your thoughts on this?
We technically not a VC, although we do have quite a few portfolio companies under our name. I think it goes back to really what's your investment horizon and what's your expectation of returns. I think the old model, not the old model, but the very popularizations of VC a few cycles back was more or less because access to teams, access to different platform that help with go-to-market. And then you have a lot of very high barrier to entry. Like let's say Belinda already mentioned, you have costs, listing costs. You have to talk to a lot of people for different geographic locations for go-to-market. You need to do awareness and this kind of thing. I think now at the moment, a lot of those have a lot less returns. And then with the popularization of AI and quite a bit of vibe coding and all of this thing, at least the PMF version, the pre-seed round, you do have to have a product. Like 2 cycles back, at a pre-seed, you basically have 5 slices. And then you present an idea, and it's not even a white paper. So for something like, we are very conservative, so for that reason, for us, it's difficult to deploy. I think, but I mean, they have very established portfolio that do really well. And the game of VC is that you only need 1 out of 20, or depending on your tech size, to make it, and then you do extremely well. We do follow the same thing when we actually deploy into private market. We do have we have so many that disappear, and so many that try to launch, and then they're really trying their best, but there's nothing much that we can do against if the market is not bullish on them. We do have a few runners that make all of the other make sense in our book, but I think the shift toward to liquid right now is just because there's a few bad actors in the scene in the VC round that have caused a bit of public distress, and that's why VC capital, which used to be like endorsement and at least a reputation for the project that, oh, hey, I got Animal Care invested, hey, I got Republic invested, so we are a really good project. And to be very honest, for us at our liquid fund, we do look at your funding rounds to check up as part of the due diligence on top of your revenue, on top of the flow and everything. We do look at all these details, and because of a few bad actors, I think now they are shifting to liquid, because also that people go to market a lot faster. So you either use the product and then farm for airdrop, or the product would release a token really fast, and you can bank on it, and then it create kind of a relationship between the project and the retail user directly, bypassing all of this and in anticipation of the token when the time is right and everything like this. We are trading in quite HFT and microstructure kind of focus. So the flow means everything to us. And retail flow means a lot more than automatic flow. So this shift has helped us identify the clear separation. Like every time there's an uptrend, it's easy, everything moves up. Whenever there's a sideways thing, you can already see what's outperforming and what's underperforming. And then more or less you would see that, okay, there's very separate token universe, and then you choose which one you want to participate in. The more transparent market would make it easier for every participant. I'm a strong supporter of that. So I'm not saying which one is better. I'm just saying that liquid has becoming a more prominent aspect to projects now.
Yes.
I think it's fundamentally just like who are you and what are you trying to achieve, right? Like that's really the question. So I think at Animoca we do the whole spectrum of things. So we are very active in private. We're very active in liquid. But I think, to be honest, like since mid-24, we definitely slowed down significantly on private deals, right? Because we're just like, the valuation doesn't make sense. We know where we are in the cycle, right? Like we're 60 to 70% of the way through the cycle, right? Roughly, give or take, right? So, you just kind of know, like, okay, this is where we're in the cycle. This is where we think the valuations are. And it's clear that altcoin valuations have repriced. It's 2 cycles ago, or like 1 cycle ago, like if you were like an L1 or an L2, you automatically get like a couple $2 billion valuation. That is not the case anymore, right? So it's just the reality of the repricing because, to Belinda's point, some of these L2s have users and some don't. So, I think that's the fundamentals. I think the key thing is it is very clear that there has been a differentiation now between like higher quality, I wouldn't say institutional, but projects that have like true longevity and you can kind of know like, both private and liquid, that these are tokens that are going to be around for a long time. And people and founders who are, in it for the short term. And like for us at Animoca, that's probably the number one thing we look at is like, do we believe that these founders are going to be in it for the long term? Because I think all the VCs have experienced this. There's been so many founders that, they list their token, they make a couple $1 million, and then they run for the exits, right? And like you're like, well, okay, that's not the spirit of us investing in you because we're here to build for the long term. So I think if you're a founder, we're always happy to talk to you, but we're very focused on people who are really just building for the long term. You're in the space for the long term, and that's really fundamentally what we look at, and we adjust our risk parameters based on our assessment of that. And we are very active in liquid because, to Belinda's point, like, yeah, okay, you can make money in liquid as long as you have a view on the price and where the token is going to trade. It's not that hard to make money in liquid, but your returns are not 100x. They're like 30, 40, 50%. And so it's a differentiation of like your spectrum of returns. Our VC book, we invest in a lot of projects. To Tal's point, like most of them die. The vast majority die. But like, one or two will make 100x or more, right? And that pays for the whole thing.
It's a big question you're asking. I would say here's something that's systemic. Venture funds, when they first started off, were of smaller vintages. As those that do end up succeeding and get to raise larger vintages are raising larger amounts of funds. Their LPs their expectations of their returns are adjusted naturally. So as you get to a fund that is going past the 100 millions and into the billions, the idea of having a more potentially secure return of 1.5 to 2x on multiple hundreds of millions or over $1 billion is going to be potentially more attractive to based off of the types of management fees that you want to end up collecting at the end of it. That's the one systemic reason. Another more tactical reason that liquids have become more interesting is because the markets have already kind of told us what they like to invest in, which is entangled with my third reason. But I'll just basically say that we shouldn't be too surprised given what's happening in crypto now because of what we see in equity markets already, especially in retail-heavy sectors, what might I say, retail investor-heavy sectors like in technology. We start to mimic equity markets where we start to identify the top few names, and then everything is just a game of figuring out who has inside information on one or the other, and then trading on that information. That brings me to my final point, which is like purely game theoretical, which is that the idea of the marginal utility of a VC investment, which is the capital plus the alleged value add the VC has, just becomes far lower in producing high returns on a VC investment relative to how capital in a public market, provided the sufficient ticket size, can affect the sentiment of something which is live trading and has all the foot traffic there already to manipulate. That is to say, in short, the VC game is convincing those post-TGE to buy at a much higher price than you bought privately, and that has become harder than putting comparable or meaningful amounts of capital towards a game where the foot traffic already is, and being able to work off of the effects of your capital in those markets.
Yes, thank you for all the insights. So I think we can switching back a bit to the retail markets because in the last few months, you can see there's a trend in the market saying all of our token lists on Binance, like Layer 0, like ZK Sync, they all list with very high, fully diluted valuation. And people think that because they have very high fully diluted valuation, but very low market cap. So Binance has like some kind of like decide to say, hey, all of the project coming here, you have to list at a low valuation. What do you think about that trend? Is this like a good way to protect your users in terms of Binance perspective? Maybe you can start with Belinda.
So you're saying now we're seeing like exchanges prefer to list tokens at a lower FPV,
Yes, like
lower valuation.
As a way to protect the users.
I think that's a right way to do, to really protect the users. Like, I'm actually like quite impressed that Binance want to push this forward. So they really try to make sure that the token that are launched on their platform start with a low valuation, so that when their users buy, like they buy maybe at 20 million, and then you go to like 60 million, 80 million, so their users make money. Because ultimately, exchange care about two things: the number of users they have and the volumes. If the users doesn't make money in this exchange, they will go, like they will either don't trade anymore or they will go to other venues. So by providing like a good investment, I would say, entry, allow them to make money, then they have more money to gamble, essentially. So I think that's a way that they finally want to give back to the community, etc., like the user group. So that's a good start. And then that's also for project to, like for teams to come to senses, like what's the right valuation for their project as well. So I think it's a good initiative and definitely can utilize that. But of course, there's no bottom. If a chart is dropping, like, you know, if the team is not good or product is not good, there's no bottom. It can go to zero. So like there's no such thing as like low valuation. Yeah.
Yeah, I see a lot of reaction from Tao when I mentioned this topic. Can you like provide the audience here some insights on it?
Okay. I think part of this is market reaction, right? You exactly like Belinda said. If you try to debut at a very high FTV, and then you counting on people not being able to understand what FTV means like last cycle, or market cap means by last cycle, and then just look at the number of zeros and decimal, and then hoping for the next Dogecoin or something, then it's gonna be pretty unrealistic now, because retail user has become a lot more sophisticated. At least, as in like generally retail users are a little bit more sophisticated, and then market has matured. You need liquidity to come in at the right valuation, and you need people to pay attention to you. If you debut at a ridiculous number and then you banking all your flow on marketing or like on the previous rounds and all the association of like different KOLs and stuff, it's not gonna really attract the general market anymore. Your flow wouldn't be there. I do appreciate the whole Binance listing at lower valuation, but we are only talking about Binance Alpha, and then listing at a lower valuation. If you look for project that actually list on Binance without having going through Alpha and directly to the holder airdrop as a spot listing, the story may not be the same. I'm not saying which one is worse. It's just that now you would have basically, the Binance Alpha is a bit more like a centralized low ticket ICO thing that people can gamble with. And now it's become like a centralized airdrop farming. It's good that you have the initial attention onto your token, be it like 2 days before they release a new one, and then you decide what to do with that window. You have 2 days to educate the market what you really gonna do what's the value of your token and all of this. And I think the low FDV encourage people to take a look at your project. It gives you a chance to take a look. And by having that access, you basically let people participate at a lower valuation. I think it's fair for both sides. It doesn't diminish away the fact that capital market need a buyer and a seller. So after the initial flow of that very small round on PancakeSwap, you need to still deliver, and you need to still pay a lot of attention to what the market is perceiving you at. The original airdrop farmer is not gonna hold your token. It's gonna be the one who buy in, and then how do you get people to buy in? How do you make sure liquidity is there? How do you encourage people to participate further, except for that 20 minutes, 30 minutes when people get rid of their airdrop? It's gonna be the long-term thing, and it's gonna be here to stay. The initial attention market give you 2 days for the announcement, and 20 minutes when your price, when everyone get your airdrop and get away. So now that you have the attention, you need to attract more serious, higher duration kind of flow, and I think that's the challenge for every project still.
So I think the way Tao put it was perfect, actually. I commend you. Very politically correct, but also speaking the truth, right? So, look, so my view on this is so you rewind back to like mid-24, right? Which is when Binance, so Binance is the market leader. They drive the market, that's clear. The reality is Layer 0 and ZK Sync just raised at too high valuations, and the market didn't price them at whatever, the multi-billion-dollar valuations that they had. But it's also true that these are legit projects, and there is a floor price of where people would bid for that token, right? You look at Layer 0 or ZK Sync, no one will say that these are bad projects. It's just that they raised at too high a valuation because that was the market. In my mind, I do think the Binance reaction to that was probably kind of perverted the market in some ways. And so I do think like actually, you know, Alpha is kind of their reaction to that. So there was a period of perversion where like Binance only listed low value tokens. But if you're a tier 1 project that has a high VC round, high valuation, then you can't list at those $20 million, $30 million value, you can't, right? So Alpha ultimately is the way that Binance differentiated between, okay, our tier 1 projects, and then we're gonna have some low valuation projects. And the reality is if you're a founder, like you should not look at Alpha as anything other than marketing. That's all it is, to Tao's point. Like Binance is giving you an opportunity to be in front of their audience for a very short period of time, and you have to maximize that attention and get the incremental buyer to buy your token. And also the reality is the vast majority of Alpha projects go down in price, right? Like that's just statistically the fact. So I think ultimately, you know, as a founder, and this is really, I guess, my key point, as a founder, you have to be real, you only get to TG once. You have to be really, really thoughtful about how you're TGing. If you are gonna go and do Alpha at an early stage, you have to know that basically what you're doing is you're using your token to market, and you're giving away your token to market your project, and you have to be able to draw people into your project and have the incremental buyer, because usually when people TG relatively early, you're basically borrowing money, you're trying to market your project and borrow money for the market for longer life, right? That's basically what you're doing. It's different if you're someone like, you know, a ZK Sync where you're, you know, you've been building like for multiple years, like Layer 0, built for multiple years. By the time they TGE'd, they had a value. There was a real value. It might have been $1 billion, it might have been $1.5 billion. I don't remember what it traded down from the whatever they listed at. But you have a value, and then you are trading on your real value that the market will give you. But for the vast majority of founders who are like basically, you know, pre-product, pre-revenue, if you TGE, you are taking a big risk. So I would say, you know, the market is maturing, and collectively as a market, we're figuring out what the right things are. And each of these tools, like even who you choose, like Binance, OKX, Bybit, like the fundamental ways that these exchanges charge for your TGE is fundamentally different, like decimal points different, right? Like, you know, Binance charges 10x of the next exchange. So you have to be very, very thoughtful about how you're TGing. And honestly, that's why, you know, good VCs are important. Good VCs don't mean you'll be successful. Whether or not you're successful is up to you as a founder. But there are VCs who really understand, like, I mean, just speaking my own book, we have TGE'd dozens and dozens of tokens. Animoca Brands knows exactly how each exchange acts, how each tool within each exchange plays into your thing. And ultimately, we advise founders, and sometimes they take the advice and sometimes they don't. And, you know, it is what it is. So I think the market, to a certain extent, you know, I wouldn't say it's efficient, but it speaks the truth.
So I would say, just to try to answer this as briefly as possible, the high FTV, low float problem is a fundamentally like just existential truth of where most of crypto asset prices are today, which is that they're still incredibly fluffy. No one up here on the stage or anyone in the audience could convince me that cash flows, buybacks, or anything having to do with the product market fit of a token justifies its value in any proportionate way. However, I will say that and that is to say now that when projects go to TGE, the main thing they're trying to do, if they're a first mover, they have all the advantages, but the risk's there. Everyone else after that is just trying to play the comps game, meaning they're trying to reach a comparative sort of valuation as another project that they think that other firms will trade them at a discount because that they're second to market, third to market, whatever it may be, in one ecosystem versus next ecosystem. So my hopes of that changing are not necessarily very high. However, the current brokenness of tokenomics and the non-willingness of many projects to try to change things up is what's going to be a constant force putting this back. Because I think what most people, both retail and perhaps even some VCs, fail to grasp. And I don't want to say this because I wouldn't be on the stage. I'd be retired and screwed off somewhere else where I didn't care about this. But the important thing about understanding these tokens is the fact that its psychology mimics far more of a perpetual auction than it does an equities business, or at least in the more cut and dry sense. So that all being said, to wrap up that point is, I do think that we will always have projects trying to copy the previous, and there will always be like a slow, almost like natural selection process to change those over time. I don't think anything's going to change overnight like that. But then further, the main issue why these things drop, we all know them. We know the reasons why. Number one, VCs, market makers, exchanges dump the thing, or airdroppers farm and then dump the thing. And this is because tokenomics and many projects are unwilling to engage in new earning mechanisms for which tokens are actually going to the highest contributors in the project. So whether you're talking about Ethereum or you're talking about even Tau, like with BitTensor, the idea is that it's a perpetual auction. Yes, everyone on BitTensor gets to more or less attest how much work each of us has done, how much we're entitled to earn. But if I lay down more tokens than you, then my attestation wins. So the point is, while that is a mercenary approach, it is a very direct approach to creating that auction psychology. And no one else can convince me that most BitTensor subnets are doing anything extremely productive that justifies that valuation. So that being said, if more projects are willing to consider how to only emit tokens to those who are going to contribute the most and convince others to buy up more and more of the token, then I think we have still a continued ability to succeed in investing in tokens, both from a public and private sense. But I think the FDV to float game is going to be something that just changes with the season. It's more or less, I would more or less consider it like an exogenous factor in dealing with projects per cycle.
Thank you, Alex, for all the answers. Also with Duke, Tao, and also Belinda. I think we all here already having a lot of insights and valuable lessons from all of the panelists here. But because due to the time limitation, so we have to say goodbye for now. I think if you are investors, also maybe builders, anyone who want to have any questions to the speakers here, feel free to reach out after this panel. And I think Okay, so here we can go here to take a picture.